7 lies about money that are keeping you broke. Hey everyone, welcome back to Profit Connoisseur. Today I'm going to reveal something that might shock you. The real reason most people struggle financially isn't because they don't make enough money. It's because they believe dangerous lies about money. These aren't just any lies. These are the exact financial myths that keep everyday people trapped in a cycle of living paycheck to paycheck while the wealthy continue to build wealth. Think about it. Have you ever wondered why some people seem to build wealth easily while others struggle no matter how hard they work? The difference often isn't income, it's knowledge. Today I'm exposing the 7 biggest money lies that might be keeping you broke. By the end of this video, you'll understand exactly how these myths have been holding you back and what to do instead. This isn't about getting rich quick. This is about building real wealth, the same way the financially successful do it. No gimmicks, no scams, just the financial truth they don't teach in school. If you're tired of financial struggle and ready to change your money story, hit that like button, and let's dive into the 7 money lies holding you back. Lie number 1. You need to be rich to invest. Let's shut this lie down once and for all. You need to be rich to invest. No, you don't. This myth is like quicksand. It traps people into thinking, I'll start investing when I make more money. But here's the truth that rich people already know. You get rich because you invested, not the other way around. Think about it. Waiting until you're rich to invest is like waiting until you're in shape before you go to the gym. It's backwards. Think about it. Waiting until you're rich to invest is like waiting until you're in shape before you go to the gym. It's backwards. Let's break it down. A lot of people assume investing requires hundreds or thousands of dollars up front. But that was the old world. Today, thanks to platforms like Robinhood, Wealthsimple, Public, Fidelity, even Cash App and PayPal, you can start investing with as little as $1 to $5. These apps let you buy fractional shares, which means you can own a piece of a company like Tesla, Amazon, or Apple, even if a full share costs $300 or more. Let that sink in. The barrier to entry is gone. What really matters? Not timing, not fancy stock picks, not being a millionaire. What matters is starting early, being consistent, and letting compound interest work its magic. Albert Einstein called compound interest the 8th wonder of the world. Why? Because when you invest small amounts consistently, those investments grow exponentially over time. Example time. Let's say you invest $25 a week. That's less than the cost of 2 Uber Eats meals. Over 1 year, that's $1,300. Over 10 years, at a modest 8% return, it becomes over $18,000. Over 30 years, you're looking at nearly $100,000 from just $25 a week. And that's with no fancy stock picks, just basic index fund investing. Here's the hard truth. The longer you wait to start, the harder it becomes to catch up. And every day you don't invest, you're leaving money on the table. Money that could be compounding, multiplying, and working for you. So start small, start scared, start messy, but for the love of your future self, just start. Lie number 2. Saving is safer than investing. Now let's talk about the second big money lie. Saving is safer than investing. On the surface, it sounds reasonable, right? Saving money seems like the smart, conservative move. But here's where people get stuck. Just because something feels safe doesn't mean it is. In fact, saving might be one of the riskiest financial decisions you make, if you're not actively investing your money. The inflation trap. Saving money in a traditional savings account sounds safe, but there's a hidden cost you're probably not considering. Inflation. Inflation is the silent killer of your savings. While you're parking your money in that 1 to 2% savings account, inflation is steadily creeping up, eating away at the value of your money. In the US, The average inflation rate over the last century has been about 3% per year. Imagine this. You have $10,000 in savings, and you're proud of it. But after 1 year of inflation at 3%, that $10,000 is only worth $9,700. Now let's say you're just letting it sit there for 10 years. That $10,000 could be worth only $7,000 in purchasing power, even though the number hasn't changed. It's like holding on to money that loses value every year. How's that for safe? But when you put that same $10,000 to work through investing, you're giving it the chance to grow. Let's do the math. Historically, stock markets have returned an average of about 7–10% annually. The S&P 500 has historically delivered about 8% average annual returns. So if you invested that same $10,000 into an index fund, even at a conservative 7% return, it would grow to $10,700 in 1 year, $19,772 after 10 years, and $76,122 after 30 years. That's right. By simply investing your money, you're allowing it to grow at a rate that outpaces inflation and builds real wealth. I'm not saying that saving doesn't have a role. You absolutely need to have an emergency fund, maybe 3 to 6 months of living expenses. But once you've got that secured, holding everything in a savings account is like putting your future on hold. Saving is for short-term goals, like a new car or vacation. Investing is for long-term goals, like retirement or financial freedom. The takeaway? Change your mindset from saving for safety to investing for growth. Number 3, investing in the stock market is too risky. Okay, let's tackle one of the biggest myths out there. Investing in the stock market is too risky. I get it. The market can look intimidating. But the truth? The real risk is not investing. The longer you wait to get in, the more you're missing out on building wealth. First things first, the stock market is one of the best wealth-building tools ever created. Yes, it can be volatile in the short term, but over time it consistently outperforms most other forms of investment. The S&P 500 has delivered an average annual return of about 8 to 10% over the past 90-plus years. Over long periods, the market has historically rewarded patient investors, even after factoring in the occasional crash. Here's where people get tripped up. They see the market drop 5% or 10%, and they panic. That's the thing about the stock market. Short-term volatility can look scary, but it's part of the ride. Let me paint you a picture. In 2008, during the financial crisis, the stock market dropped more than 40%. It was a tough year for investors, but by 2017 it had recovered and hit new highs, with an average annual return of about 10% over that decade. Now, I'm not saying there's no risk in the stock market. There is, just like with anything in life. But here's the secret. Diversification is the key to reducing that risk. You don't have to bet everything on one stock. You can spread your investments across different industries, companies, and even geographies to reduce the impact of any single bad investment. For example, index funds like the S&P 500 ETF spread your money across 500 of the largest U.S. companies, reducing the risk of any one company dragging down your portfolio. Another way to reduce risk: don't try to time the market. The key is consistent contributions, a strategy called dollar-cost averaging. It's simple. Invest a fixed amount every month, regardless of what the market is doing. Let's talk about the real risk of not investing, missing out on compounding growth. Let's say you have $10,000 sitting in a savings account earning 1% interest. After 1 year, you've made $100. But if you invested that $10,000 in a broad market index fund with an average return of 8%, that money would grow to $10,800 in a year. Over 10 years, your $10,000 could grow to nearly $22,000. The real takeaway? Investing in the stock market is not too risky, not if you have a plan. Diversify your investments, invest regularly, and don't get bogged down by short-term volatility. The real risk is not investing. Lie number 4. All debt is bad. Here's a big one that traps so many people in financial mediocrity. All debt is bad. We've all heard this one, right? The advice to get out of debt as quickly as possible, avoid loans like the plague, and never, ever use a credit card. Well, I'm here to tell you, not all debt is bad. In fact, some debt is necessary for building wealth. When people believe that all debt is bad, they end up ignoring the opportunities that can actually make them wealthier. They might pay off a low-interest mortgage early, or avoid using business loans that could help them grow a profitable business. Let's break it down. There are 2 types of debt: bad debt and good debt. Bad debt is high-interest, non-productive debt, the kind you accrue on things that lose value. Credit card debt, that shiny new phone you bought on a high-interest credit card. Payday loans with sky-high interest rates. Personal loans used for lifestyle purchases like vacations or cars that depreciate immediately. Now, let's talk about good debt, the kind that helps you build wealth and grow your net worth. Real estate debt, buying a rental property with a mortgage that generates income. Business loans to expand your business, hire employees, or improve operations. Student loans for education that will increase your earning potential. Mortgages for property that will appreciate in value over time. The key here is that good debt is productive. It helps you generate more income or build wealth over time. Here's a mindset shift. Leverage is not a dirty word. The richest people in the world use leverage all the time. They just do it strategically. Think of real estate investors. They don't buy homes with cash. They leverage other people's money, mortgages, to build a real estate empire. Business owners use loans to expand their businesses. They're using debt as a tool to create more wealth. That's the difference between the wealthy and everyone else. Wealthy individuals understand the power of using debt to scale and increase their net worth. The real problem is not debt itself, but bad financial habits, impulse purchases, unplanned spending, and the failure to invest in assets that generate income. If you have bad debt, get rid of it as fast as possible. But if you're in a position to use debt for growth, then do it strategically. The takeaway: not all debt is bad. The wealthy don't avoid debt. They use it wisely to grow their wealth, and so can you. Lie number 5. You need to time the market to make money. Let's bust this myth wide open. You need to time the market to make money. This one keeps a lot of people stuck in analysis paralysis. They're waiting for the perfect moment to invest, the perfect time to buy low and sell high. The problem? Timing the market is almost impossible. Here's the thing. No one can consistently predict when the stock market will go up or down. Not Warren Buffett, not your financial advisor, and definitely not those so-called experts you see on TV. Sure, we've all heard stories of someone who bought a stock at just the right moment and made a fortune, but those are outliers, not the rule. Most people who try to time the market end up losing money because they miss out on critical periods of growth. If you try to time the market, you're basically betting against the odds. Markets are unpredictable, and the best days in the stock market often come right after the worst ones. If you miss just a handful of the market's best performing days, it can significantly reduce your returns. Instead of trying to predict when the market will go up or down, focus on the long-term growth of the market. Focus on consistency over perfection. Rather than trying to time the market, invest regularly through dollar-cost averaging. Here's the secret to wealth building that most people miss. Time in the market beats timing the market. What does that mean? Simply this: the longer your money is invested, the more it can grow, regardless of short-term fluctuations. Let's say you invested $1,000 in the S&P 500 in 1990. By 2020, even if you just let it sit there, that $1,000 would have grown to over $7,000, thanks to compound growth and the long-term upward trend of the market. What about market crashes? Here's the deal. Market crashes are a normal part of the cycle. If you sell in a crash, you lock in losses. When the market recovers, you won't be part of that growth unless you reinvest. And by then, the market has already moved past where you sold. The key takeaway is simple. Patience and consistency are the real keys to making money in the stock market. Stay consistent, stay patient, and invest regularly. It's not about timing, it's about time. Lie number 6. Investing is only for the wealthy. Let's smash another common myth. Investing is only for the wealthy. I hear this one a lot, and it's one of the most damaging myths because it keeps average people from getting started with building wealth. The truth? You don't need to be rich to invest, and you don't need to start big. Historically, there's been this belief that you need thousands of dollars to start investing. But that's not true anymore. Thanks to technology and fractional shares, you can now start investing with as little as $5. Fractional shares mean you can buy a portion of expensive stocks like Apple, Amazon, or Tesla without needing to fork over hundreds or even thousands of dollars. Let's break this down a bit more. Start with what you have. If you only have $50, great. Start there. Be consistent. If you invest even just $50 a month, that's $600 a year. The power of compounding. The earlier you start, the more time your money has to grow. This myth comes from the idea that you need a large sum of money up front to make any real money. But here's the reality. It's not about the size of your initial investment. What matters is how much you invest over time and how early you start. If you start with $100 and you add $100 every month into an index fund that earns an average of 8% annually, after 10 years, you'll have over $21,000. The key is starting early, no matter how small. One of the smartest, most effective ways to invest is dollar cost averaging. Instead of trying to time the market, you invest a fixed amount of money at regular intervals, say, every month, regardless of market ups and downs. One of the biggest barriers to investing is simply not knowing where to start. Many people think investing is reserved for the elite because they don't understand the basics. But you don't need an MBA to make smart financial decisions. Wealth doesn't always come from being born into money. It comes from making smart decisions over time. Start small, but start now. Take advantage of fractional shares and low-cost investment options. Focus on the long term and compounding. It doesn't matter how much you start with. What matters is that you start and stay consistent over time. And lastly, lie number 7, investing is too complicated. All right, it's time to break down the final myth. Investing is too complicated. Now I get it. You've probably seen financial jargon thrown around, heard people mention complex charts, and thought, this is just too much for me. But here's the truth. Investing is not as complicated as it seems. First, let's talk about the basics. Investing is simply putting your money to work so it grows over time. You invest in things like stocks, bonds, mutual funds, or real estate. You buy these investments with the expectation that they'll increase in value over time. Here's where the myth starts: the overwhelm. We often see people on TV or in the news making complicated investment strategies seem like the only way to succeed. There's talk of options trading, futures contracts, and endless technical analysis that can leave anyone feeling like investing is just too hard. But guess what? You don't need to understand everything to start investing. You don't need to become a stock market expert to begin growing your wealth. In fact, the simpler you keep it, the better. Start with what you understand. There's no need to get bogged down by jargon and complex strategies. I suggest you begin with index funds and ETFs. These are some of the simplest investment vehicles you can start with. An index fund is a collection of stocks that represent the overall market, like the S&P 500. These types of investments don't require you to pick individual stocks or worry about timing the market. If you want to make investing even simpler, you can use a robo-advisor. These are online platforms that help manage your investments for you based on your goals and risk tolerance. The truth is, you don't need to do anything complex to see your money grow. Long-term strategies like investing in broad market index funds and ETFs have been proven to consistently outperform most complex strategies over time. In today's world, there are so many tools that make investing simple and accessible. Investment apps like Robinhood, Acorns, or Vanguard's app allow you to easily start investing with as little as $5. Automatic investment options can take the complexity out of deciding when and how much to invest. So here's the bottom line. Investing doesn't have to be complicated. Start small, pick simple strategies like index funds or ETFs, and be consistent. Don't let complexity stop you from getting started. Remember, it's not about knowing everything right away. It's about starting with what you can understand and growing from there. If you're still feeling like investing is too complicated, I've got good news. You can start today with the simplest strategies. Don't let the fear of complexity hold you back. And there you have it, the 7 biggest money lies that might be keeping you broke. Now you know the truth. You don't need to be rich to invest. You just need to start. Saving isn't safer than investing. Inflation is eating your savings alive. The stock market isn't too risky. Not investing is the real risk. Not all debt is bad. Strategic debt can build wealth. You don't need to time the market. You need time in the market. Investing isn't just for the wealthy. It's for everyone who wants financial freedom. And investing doesn't have to be complicated. Simple strategies often work best. If you've been believing any of these myths, don't feel bad. Our financial system was never designed to teach you these truths. The wealthy learn these lessons from their families and networks, while the rest of us are taught to play it safe, which ironically is the riskiest financial strategy of all. The good news? Now you know better. And as Maya Angelou said, when you know better, you do better. I want to hear from you. Which of these money myths surprised you the most? Drop a comment below and let me know which one you're going to tackle first. If this video helped you, please hit that like button, share it with someone who needs to hear this, and subscribe for more financial truth bombs every week. Remember, financial freedom isn't about how much you make. It's about what you know and what you do with that knowledge. See you in the next video.